Thanks so much for your company for the weekly update. I'm Jessica Amir, a market analyst at Bell Direct. Well, what a busy week it's been for equity markets, with global equities continuing to rally, reversing from a sell-off. The Aussie share market up 6.2% just Monday to Thursday, now down in the order of 21% this month. Global equities are expected to pick up for a couple of key reasons though, particularly as we approach the end of month and quarter next Tuesday. The reason for this is US pensions and local investment managers are rebalancing their portfolios. So in theory, we should see equities continue to rally. This is why we've seen a lot of institutional buying taking place this week on the ASX, in particular pushing up Afterpay up 56%, corporate travel management up 47%, Avita Medical AVH up about 26%, and CIMIC up about 22%, while the toll road operator Transurban is up 22%. And that's just looking at the ASX 200 institutional buying, which has pushed up those to some of the best performing stocks this week. But still, pressure is likely to remain on equities until quarantining ends, along with travel bans, and then business should return to normal. So today we'll cover three things. Where are we headed economically? Taking a look at two, the stocks that you could find the most upside in, given that we're headed for a short, sharp recession and possible a quick rebound. And thirdly, we'll leave you with a tool to find outperforming investments. So let's get started. First off, where are we headed? Let's consider global productivity has almost ground to a halt if you compare that to how we were tracking about 2 months ago. The 2020 Tokyo Olympics have been moved to 2021. For us in Australia, non-essential services are closed. Scores of businesses are now working from home, and it's also the case in many countries around the world too, except China, which continues to return to work. On the other side, we've got record stimulus to combat the economic slowdown. The Australian Prime Minister's second coronavirus stimulus package paved out how the government is helping employers who turn over $50 million, also giving pensioners, carers and senior card holders a $750 payment. For casual and sole traders as well, they could also receive $550 fortnight payment for the next 6 months. And in the US, record stimulus is underway as well. A record $2 trillion coronavirus relief package is underway in being approved. That's Australian time. We'll learn if the House approve the rescue bill to support Americans through coronavirus. If it's approved by the House, it's over to President Donald Trump to sign it off. So for the economy, many forecasts are now suggesting we'll have a recession, which is 2 consecutive quarters of negative growth. Citi expects it'll be the largest quarterly decline of Australian gross domestic product or growth ever recorded, at negative 5.7 in the second quarter of this year. That's following the first quarter's forecast decline for this quarter, which is expected of negative 1.2%. Remember, we also have no guarantee that global infection rates will peak. And secondly, we also have to bear in mind the worst case economic impact of social distancing. Citi says it could cost the global economy $100 billion just in the second quarter alone. With this in mind, where can we find the most upside? Well, let's assess the magnitude of the risks that the ASX companies are facing amid COVID-19. Well, banks are coming up well, so too are consumer staples. Citi, however, favours those quality names in the healthcare, staples and mining, remembering businesses need to increase their debt to continue to pay staff and their debt. So there'll be more upside in the banking sector. In the banking sector, Citi prefers ANZ. And amid the stockpiling, another business to consider is the pallet business Brambles BXB, as it's got a good balance sheet. Citi also says other more defensive staple names that it likes include A2 Milk, Aristocrat and Next DC. And if spot commodity prices fall 35%, Citi says it still favours BHP as it's cheap. So with the focus on government spending, likely to also favour healthcare and R&D spending to combat COVID-19. Given budget deficits will be large, and potentially we can expect higher taxes later this year to help fund that budget deficit. Citi says it still favours healthcare, in particular CSL. So let's stay on healthcare. What does Morningstar say, the research and investment house? Well, their 5-year outlook has surprisingly remained the same. They, however, are continuing to favour the biotech company CSL as well, and the ventilation maker Fisher & Paykel FPH, which has been doing great things in terms of performance on the ASX this year. Citi says CSL and Fisher & Paykel will be resilient, and it could be an opportune time to buy CSL. Changing pace in the healthcare sector, Australian pharmaceutical distributors EBOS, EBO and API is their ticker code, and Sigma, SIG, could also benefit from increased volumes as people self-medicate to boost their immune systems. Blackmores is another one to watch, BKL. They boast the largest market share in the vitamin and dietary supplement category, and they're likely to see more demand. So watch this space. So perhaps it's time to consider other sources of quality investments, particularly if you don't have time to research all of the ASX listed and global companies that fit into the quality category. Remember, quality means low debt, high return on equity. So instead of looking at those quality names on the ASX and around the globe without stock picking, you can access quality names via exchange traded funds or ETFs. In fact, the quality index that some fund managers mimic has been outperforming over this crisis. In particular, the S&P ASX 200 quality index has declined less than the ASX 200 by 8% year to date. So quality continues to outperform, and this is not something that's out of the ordinary. In fact, if you look at the international quality indices in the US, Europe, and Japan, they've all gained 2%. Again, this is nothing new. Quality continues to outperform around the globe as it has done for the past decade. So for you, Aussie share investors, if you want to look at quality ETFs available on the ASX, I suggest you head over to Beldirect's ETF filter. And then once you're there, in the top right hand side of the page, literally type in quality in the search bar once you're in the ETF filter. Then you'll see 4 quality ETFs which have gained between 10 and 23% year on year. Just outstanding. So in closing, let's remember, when you're searching for quality on the ASX and in the ETF landscape, remember to factor in all those tools that you can possibly get access to. Remembering, companies with high repeatable earnings, low debt, have a history of outperforming through all economic periods. Thank you so much for your company. I'll see you next week for the monthly wrap on Tuesday. Don't forget to tune in each and every day for the daily market update. Take care, stay safe. Bye for now.